the replacement project case. Yes, please.
They asked the password for the meeting in the chat.
Okay, it's I think KeyMap with small letters. It's KeyMap. Now, okay, the replacement, that was the expansion. And this is the replacement we had it. Okay, here, that, yes, that we get. So we didn't have any revenues. So in here we have revenues too. And on the other side, we would like to buy a new equipment with the cost 1 million. The life is 10 years. The annual sales 450, and the cash operating expenses 150. Annual depreciation is 100,000. Accounting salvage value is 0. Expected salvage value 200,000. But my question in here, why do you think this guy would like to replace the equipment? What is the main reason? Just haven't looked to the table, which is given here, data, and you can come up with the idea like why this guy would like to replace the equipment.
Increase sales?
Increase the sales, yeah, we can see the sales dramatically increases, like from 300 to 450. But in the previous case, we had cost cutting, like efficiency in terms of the cost. But in this case, it's a sales matter, yeah? Now, so I will get this data and put it into Excel so that we can use it. So here, I will have the following. I have old, and I have sales. But before doing that, let me put all the data parameters like current book value, current market value. So I will copy all. Hope it works. No, it doesn't look like this. So
one by one.
yeah, but one by one. Book value. Let me make it like this. Yeah. Book value is 400. Allow the recording. It's already recorded. Why she wants to record? 400,000. So market value. 600. So the difference in here is that the current book value is the remaining value of the asset. Yeah, it's 400,000, and the market value means that we will be able to sell. So having this information, can you tell me, are we gonna be paying any tax on that when we will sell it?
We will.
Yes, because we are making some profit on that. Yeah. Remaining life. I'll just put the life of the project 10 years. And annual sales 300,000. And I have OPEX 120. And I have annual depreciation. Which is 40,000. Accounting salvage value is not given, so I don't need it, like an expected salvage value. Expected salvage. Expected salvage, 100,000. Okay. So on the other sides, we have acquisition cost. $1 million. The life of the years is the same. life is 10 years. Annual sales, we have 450,000. And cash operational expenses, OpEx again, for the new ones, 150,000. Annual depreciation is 100,000. And we have expected salvage value. $200,000. Okay. So this all data should be entered. So this is the old equipment, old, and this is new. Okay. Did I miss anything? Yes, there's like tax rates. And here it says new equipment replace the old equipment and additional investment of 80,000 in net working capital will be required. So it means that and net working capital will be 80,000. Tax rate is 30% and required rate of return is 8%. This data should be entered too. So tax 30%, required rate of return or discount rate is 8%. And net working capital is 80,000. Okay. Anything else? Now, again, there are three stages that we need to follow. First, let's calculate the investment cost, the initial outlay. Did you all enter the data? Okay, let me wait a couple minutes. Now, to calculate the investment outlay or initial outlay, let me call it investment outlay. We will be following the formulas, okay? How much money we spend to buy the new equipment?
1 million.
1 million, yeah? And 80,000, the net working capital. And we have something that we are selling.
Yeah.
The old equipment. For how much we will be able to sell it? 600, yeah? We will minus, yeah? Because this money comes into the company, it should be subtracted. It should be deducted because it's a cash inflow. And of course, whenever you sell something, you have to pay the tax on that. So plus or minus?
Plus.
Why plus?
Because that was the.
It's an outflow. It's an outflow. Okay. So the tax is 30% multiplied by the difference between the market value and the book value. Yeah. So this minus this. Do you want me to repeat it? So investment cost because we buy the new equipment, net working capital because we start a new business, we need extra money to be penetrated into the business, minus the 600,000 because that we are selling the old equipment. We're not going to keep it. And we are adding the tax amount because we sell and we make some profit. We have to pay tax on it. Okay. So the first step done. Any question? Okay, now Now we need to create incremental cash flow analysis. Like, do you remember that we created like old sales and revenues for all years? And the same thing that, and then we get the differences between these two. Like we can do it the same way or directly like alt, let's do it alt. Sales, OPEX, and depreciation. The same gonna be for new one, but in here I have new. But it's going to be for 10 years. I need to calculate for 10 years, make it like this, 0, 1, 2. Okay. So my sales is 300,000. Fix it because all years is the same. OPEX is 20. And my depreciation is 40,000. And pull it to the right.
Straight line, right?
Yeah, it's straight line, like they're same. Just fix it and pull it to the right. And the same thing I'm gonna repeat for new. So the cash flow projection has got 3 steps. Estimation of the investment cost, estimation the cash flows, and estimation the terminal value of the cash flow. Non-operational cash flow. So the first we done it, now we are moving to the second one. So sales of the new, OPEX new, and annual depreciation new. And again, I pull it to the right. Okay. So that's what I have it. Okay. Now we move to incremental analysis. Incremental cash flow. Sorry. Sorry. Yeah, that's true. That's a very good question. Why we need to start from 0? 0, it's a year of the investment. We don't have any cash flows. Yeah. Even the old one, we don't have it. This one, like this.
And one more question.
Yeah.
Why would we start calculating new equipment from year 0 if we are?
No, we don't. We don't. I removed it.
So we
So sales and operational expenses, they start actually from the year 1, as usual.
both for the older
And for the new one, yeah. And the incremental cash flows here. Okay. And again, I'm gonna copy it, sales here. So do you have any questions? And incremental cash flows means like we're gonna get the discrepancies, we're gonna get the different differences like new minus old for all years. New minus old. That's where I have it. Okay. Yeah. New minus old. Like new sales minus old sales. New OPEX minus old OPEX. New depreciation minus old depreciation.
in which year it is planned to actually replace the equipment?
It's on the, we assume that we are in a year that we want to replace it. If we don't replace it, the old equipment will function 10 years.
Okay.
If we replace it, the new equipment will be functioning for 10 years too. So we replace for the last 10 years. Okay. And now we can calculate EBIT. This minus this minus this. So sales minus OPEX minus depreciation will give you EBIT. Okay. And interest, we don't have it. The only thing that we need to tax, which is 30% of EBIT. Wait for you. It's 30%. It's a 30% of the EBIT. It's a tax amount that you're calculating. The next step, it's a cash flow after tax. Cash flow after tax. And we have depreciation, where we'll add the depreciation back. And we have total cash flows. Okay. Total cash flows basically when we add the cash flow after tax to depreciation. Okay. And the initial investment cost we already calculated, which is here. Sorry? Yeah, it's from initial investment that we calculated from the beginning, investment cost. I just put the minus sign after the equal and just getting that number that we calculated. And now?
We can calculate.
No, not yet, not yet. We need to calculate the terminal value of non-operational cash flow. So it's the last step that we do it. It's a thing that you're selling it at the end of the day, like expected salvage value.
Yeah, could you elaborate more about terminal value?
It's basically trying to measure the value of the firm, like throughout the whole operation. You're assuming that you will close down, you will finish your project after 10 years, and the equipment that you have, the new one that you bought it like 10 years ago, you will sell it and you will get some money on that. Plus the net working capital that you have put into the business, you will get it back too. And the equipment that you sold it, you have to pay tax on that if there is an income on that. Yes, sure.
What is the reason that we have the depreciation back to you?
Okay, the first depreciation, when we subtract it, we subtract for the tax purposes.
Yeah.
Yes, that's true. That's logical. And when you estimate the cash flows, it's a non-cash item because you don't incur this cost basically. It's basically the equipment you depreciate it in value. And when you project the cash flow, you already subtracted this cost, but it's a non-cash item. Logically, it should be added back when you estimate the cash flows.
Oh.
You make the cost, but in reality, you don't make this cost.
Yeah.
But you show it with the purpose to pay the taxes. Once the tax issue is removed, you should put it back. And regarding the depreciation, it's a simple here, okay? One equipment. But if it's like factory, each item has got its own way of depreciation, because you cannot depreciate the mobile same as the car. You cannot depreciate the building same as equipment. Each item has got its way of the depreciation, and it's given by the tax office, that depreciation. You just the accountant, they do these calculations, and you get this all depreciation and use it. Now, okay, that's what I want to do. Now let's go with the terminal value of the cash flow. As we know that the expected salvage value of the new one here, and if you remember the formula here of the terminal value, look at here, what it says, salvage value of the new one minus old one, plus net working capital, minus tax, salvage new minus book value, salvage old minus book value. That would give you depreciation. So that will give you the terminal non-operational cash flow. So if you go back to the data parameter that we are given here, check the old one is here 100. And the expected salvage value of the new one is 200. So it's given. So this 100, it means that if we did not replace the old equipment, then at the end of the project, when 10 years over, we would be able to sell it for 100,000, the old equipment. This is what it tells you. But we are selling it still, but for the purpose of calculation, the incremental analysis, we need to consider it. So we go to the last year. New minus old. New minus old. Plus net working capital. Minus tax rate. Yeah. Which is 30%. Multiplied again. New minus old. New minus old. Twice. Why? I will elaborate a bit more. Okay. Let me just finish it and I'll come to your question. Look at here. You can see here, there is no problem, new minus old, but we did the same thing here, new minus old. But once we don't have the book values at the end of the 10th year, we assume it's 0, we directly subtract the new minus old. If there was something remaining from the new equipment or from the old equipment, maybe by structure, it cannot be depreciated fully during the life of the project. It can happen because you buy the equipment, you don't assume that the equipment will be fully depreciated during the project's life. Because sometimes you buy the equipment, it will last more than your project will last. You assume like the project gonna be lasting 5 years, but the equipment is depreciated in 10 years. So the remaining value still be there. But in our case, it's depreciated directly to 0, means we will be utilizing fully. So it means that the book value here and book value here, end of the project 0. And basically salvage new minus salvage old. So if you come here, open it and see.
So, am I correct? If the book value is 0, that's why we pay taxes. But if the book value were equal to salvage value, there will be no taxes.
Yeah. Now here, this is new. This is old. Again, new minus old. And this is our net working capital. This is the tax rate. Okay.
So what's the exact logic behind
Sorry?
the logic behind subtracting
taxes.
new equipment from old equipment.
No, it's just incremental analysis. When we kind of see we subtracted all the like new minus old. When you do the incremental analysis, you should subtract all items difference. You should get a discrepancy or differences of all items, like sales, OPEX, depreciation, and terminal value when you calculate salvage value, because we have the new salvage value and we have the old salvage value.
So I understood about the taxes.
Okay.
That's clear. I understood about the net working capital.
Yeah.
That's clear. So why exactly do we need? Because we are comparing new and old.
Yeah, yeah.
So that's why we need.
Yeah.
To.
See, the difference that you get the result between the old and new, if it's positive NPV, then it tells you go with that project, replace it. If the difference is you get the negative
So
NPV, there's no point in buying the new and replacing it. Okay. Now we can calculate NPV. Yes, please.
When you identify, you're finding out 150,000 BNOs.
Yeah.
You said that 30% tax rate multiplied by old
New minus old.
New minus old. You said twice. You mean that
Twice, I mean at the beginning when we calculate here, the formula tells you do it like here. New minus old. First one and the second one here. Why
Sorry.
twice in here? Because the book value is directly 0. And it basically becomes new minus old.
Sorry, shouldn't we add for total cash flow for the last year?
Yes, we're gonna come to that point.
Okay.
Thank you. So at the end of the day, so we will add this to the total cash flow. Okay, what we're gonna have it here. So then we can calculate our NPV. NPV is basically here, the rate is given to rate, if you calculate NPV, rate is 8%. Values are here. And subtracting the investment costs. So we can see it's a positive result, which tells you it's good to go with the replacement of the old equipment. So you can go and replace. Yes, please.
can you please upload this file to the LDAS so we
I will send to WhatsApp. Okay, I cannot upload it here. I don't have this. I will share it in WhatsApp. Yeah, sure, definitely. I will. Please, guys, if you have any questions, because in 1 week we'll have the quiz and the midterm. So you have to know how to do it. Replacements. So what do you want me to show it again? NPV. Okay. Did you add the last total cash flow? Formula, okay. Okay, it's basically this one, yeah? We are adding the 3 items: depreciation, cash flow, and terminal non-operational cash flow. It's a, this is salvage value of new and salvage value of old. This is salvage value of new, salvage value of old. This is the tax rate. And this is, sorry, this is the net working capital, this is the tax rate. So it's good to use the Zoom because it allows you to kind of draw on that. Perfect. Now, if you don't have any question, I will save it. And did anyone try to do the activity at home? There was one student who did it already. Try to do it at home. If not, so go to activity and do it, start doing it. Go to an activity, it's a question about expansion project. You finished, yes?
Yeah.
So for you, another activity. So go for the book, okay? At the book, the page is 100. There's a spreadsheet modeling. Yeah. Capital budgeting with a spreadsheet. The page is 100. Just, okay. So go and replicate this one in Excel. Specifically, I want you to replicate these numbers, minus 50, minus 63. Don't put just numbers, okay? You need to calculate them. You put the data parameters and you should get the same results like this. But in Excel, it should be automatically calculated, okay? I had already asked this question in the exam, similar to this, how to calculate the net working capital investment in increasing order with a cumulative approach. Like every year you invest something. So it's a very good question. So anyone, if finished, just go with this.
So that's in-class activity, right?
Yeah, activity 2, just do it. The book is in L drive. You finished
The
activity 2.
no, so that's the activity.
No, that I showed it's for him because he has finished at home. If anyone has already performed the activity 2 at home, so there's one question that you need to go is this one. Page 100. Activity 2. It's empty. Just a second, just a second. Just a second, I'm coming. Some of you might not have the question itself. I'll fix it out now. Yes.
100 or one?
Oh.
Which one? 100. So
No. Page 100. One thing at one. Put 100. Yes. Yeah, yes.
Okay, thank you.
Okay, this is the activity that you need to go. This is the question. Yeah, XYZ Corporation, that's true. And I guess this advanced corporate finance doesn't have it. Yeah, they don't have it. I'll put it now. So you have to as well. I just put it and update it. Guys, now let me just give you kind of brief. It's very easy question. You can make it faster, but the only thing that you will be kind of challenging is when the interest rate will be increasing every year. So first calculate using the all investment criteria, NPV, IRR, payback rule, MIRR, with the fixed interest rate. And then second condition, when the interest rate increases every year by 2%. Like, yeah, until it finished the project. So you have the price per unit, variable cost per unit, fixed cost per unit. And if you have this information, you need to calculate the sales revenue. You have to calculate the OPEX, the cost of goods sold. Yes. Now the sales revenue is not given. You need to calculate. Yeah, cost of goods sold or OPEX is the same. It's not given. Yeah, it's here. The information which is given here, you need to go with it. And the project is expected to have the useful life 5 years. The company expects to sell 10,000 units of the product per year. And they make $500,000 investment. No. For now, if you can do it with someone, there's no problem, but you can do it. But in the exam, believe me, there will be no chances. Exam will not be on your computers. Exam will be on the computer labs that we have upstairs. Yeah. Yes. Yeah, it's very suspicious. No, depreciation, it's use the straight line method. Tax rate is not given to. You're living in United Arab Emirates, they don't pay taxes. Now, the taxes, make it 30%. Why didn't give the taxes?
To Europe.
Yeah. Now we're just basically trying to create, this was the expansion project, but what we are trying to do here, we're trying to create the sales. It's just an expansion that we are selling it. We are selling it. What we are selling? We are selling, let me make it bigger, so that you can see it. Here. In here we are sell, we are kind of investing $500,000. This is our investment cost. Like it's money that will go. Just like the investment. The life of the project is 5 years. Very fast. Just by the number of the years divided by number of years. Life is 5 years. So unit sales, just like the unit sales. Unit sales. So all the data is had. Companies expected to sell for, okay, the price per unit is $50. For price per unit. Yeah, but for how much money you would get? They sell it $50 each unit, and they sell in total 10,000 units. So the revenue in total would be 10,000 multiplied by 50.
Sorry, do we have depreciation?
You need to calculate on your own. Use the straight line method depreciation. Just a second.